Good evening, everyone. Time for another silver update. We are right at the Asian market open. You can see, go to the tick chart here. We had a little drop down on the initial opening. Now we're rallying pretty strong. So the big news story over the weekend was the margin requirement hike that was announced by the CME, and that story was initially broke on Zero Hedge. Now this story here is a follow-up story, and this is an announcement by ICE, which is it's International Commodities Exchange, and they have clarified this issue about the initial margin requirements and maintenance margin requirements. Before I jump into that, I just wanted to explain to you, if you don't understand how these things work. This is a page from Heritage West, just a futures broker, that explains the distinctions between these two margins so you can understand that. And I'll read that. An understanding of margins and of the several different kinds of margin is essential to an understanding of futures trading. Rather than providing a down payment or being a cost, the margin required to buy or sell a futures contract is solely a deposit of good faith money. Minimum margin requirements, which are typically about 5% of the value of the futures contract. Now that's very interesting there, because we know that silver was almost as high as 20% and is now still hovering around 15%. 5% of the value of the futures contract are set by the exchanges. Exchanges continuously monitor market conditions and risks, and as necessary, raise or reduce their margin requirements. There are two margin-related terms you should know: initial margin and maintenance margin. Initial margin, the deposit required to initiate either a short or long futures position. Maintenance margin, if and when the funds remain available in your margin account are reduced by losses to below a certain level, known as the maintenance margin requirement, you will be required to deposit additional funds to bring the account back to the level of the initial margin, or you may also be asked for additional margin if the exchange raises the margin requirement. So that's the issue. Now, the reason why this became an issue over the weekend is, if you've been following the bankruptcy of MF Global, this is one of the many clearing firms that was involved in futures trading. So there were a lot of traders who had positions that they held with MF Global. So the issue was, with the bankruptcy of the company, the regulators are charged with the responsibility of moving those accounts over to other brokerages. Now, the reason why this became an issue was the initial announcement by the CME was that margins for all commodities, maintenance margins, would be raised up to the level of initial margins. Now, you have to understand the reasoning behind this. Remember, just as we had with Bear Stearns and Lehman and others, when we have a bankruptcy, we have the government involved in trying to get the assets moved to another location, or the investments or the positions or whatever you have it. So we've got a large number of futures positions that some are in the good, in other words, they're making a profit, but others are at a loss. The ones that are at a loss, if they're moved to a new firm, it's possible that that new firm would say, well, hold on, there's not enough margin in here, because they would look and say, based on the initial margin, there's not enough cash posted for the amount of futures contracts held. So that's the reasoning behind why the CME initially announced that they would move maintenance margins up to initial margins that would allow them to move these accounts over to the other brokerages and be established at initial margin requirements. Now, what's fascinating about this story is that, first of all, that it was broke on Zero Hedge. As far as I know, the story was broke on Zero Hedge, and that ended up having the CME reacting multiple times with tweets and Facebook updates and things like that. Now ICE has come out and given an update. So the latest news, and the reason why that's important is because that the alternative press is driving these news stories. The fact that a story on Zero Hedge could actually impact the actions of the CME, that just goes to prove how far we've come with the power of the alternative media. So back to the main story. What has happened now is that the CME has clarified the issue, and since the issue is getting these accounts to new brokers, and the big controversy was all these people having to put up a ton of money to get back up to initial margin from the maintenance position they were at, which would cause a tremendous cash crunch on Monday when the markets opened. They've decided, instead of raising the maintenance margin to the level of initial, they're going to lower this initial down to the level of maintenance. What that is going to do is it's obviously going to allow everyone who has a current position that is within the regulations of maintenance margin to just move that over to a new brokerage, and there won't be an impact as far as a cash crunch. So that's where we are, and this is the announcement by ICE. Effective immediately, ICE Futures US is temporarily lowering the initial margin rate for all speculative accounts to a level equal to the maintenance margin rate for all contracts. So instead of raising the maintenance margin rate up to the initial, they're lowering the initial down to the maintenance, and that will allow all these accounts to be moved to new brokers from the bankrupt MF Global without having a huge cash crunch or run, with especially traders who aren't able to immediately raise that amount of cash and therefore are forced to sell, which would cause tremendous deflationary pressure on all of the futures markets. So that's the story. I hope that clarifies that. As you can see in the silver chart, we had an initial reaction down, but now we've bounced back up. That's silver. On the gold chart, you can see we're rallying, and we've been in a fairly strong rally, and I'm going to get to those technicals when I look at the Jim Willey article that I'm going to cover here. So it seems to be kind of a non-event now. It was potentially a large event if the cash crunch would have occurred, but we're now back to basically where we were at the close. So it's a non-event at this point. Now back to the technicals on the silver. We are rising in the MACD, just barely. We're just barely rising. We've formed a bottom, and the bottom that I've chosen as far as the spike bottom that I think is a predictor of future up moves has held as well. I think it's going to hold. I don't think that we're going to test any lower than we already have. I think with this MACD beginning to form a bottom and rounding up, when we do see a crossover on this weekly MACD back up into the positive, I think that's when we're going to get our move. Now, a lot of people have questioned my call for $100 silver by the end of the year. I'm still going to stick by that call. Some people have said it's irresponsible for me to stay by that call. I just want to clarify a couple reasons why. First of all, there's a lot of realistic projections that have projected for $2,200 gold by the end of the year. If you remember, when silver was nearing 50, we were at about 1,900 on gold. If we do get a $2,200 price for gold by the end of the year, I don't see any reason why we won't surpass significantly the silver price that we had, because as you know, silver always plays catch up. So if we do get that rise to 2,200, we're going to move, say, 20 or 30% above this price. 20 or 30% above the $50 silver price is going to give us a price of maybe 60 or 70. And with that move, I believe once we get above the $50 price in silver, we're going to see a piling on effect that will be amazing. So I'm still standing by that call. If this rally, especially the one in gold, does not pan out, I will definitely have to revise that call. So I'm still standing by that call. We're going to wait and see if that happens. Now, I wanted to announce about my channel. I've made a number of changes to my channel. First of all, you'll see ads running on my channel because I've enabled that, and as I pointed out before, I believe in the ad model for media, and I don't see anything wrong with it. The ads that are on my channel are going to be TrueStream. Those are the ads that you can click off after 5 seconds. I've had a lot of people who have requested that I put up links for donations and other things like that, but I'm not really comfortable with doing donations on my channel. So what you'll see on my channel is a new banner, and this will link to my Twitter page, and then you will see the TrueStream ads that you can click off of if you want to. So if you want to support the channel, now I do have a Bitcoin link that you can use, but Bitcoins have kind of stagnated, and I don't really want to talk about that right now. But if you do want to support my channel, I encourage you to support the advertisers on my channel and watch the ads to the end. Those are more supportive of the channel if you watch the ads to the end. But if you are bothered by those and extremely upset by that, go ahead and you can click those off. So I hope that that doesn't really bother too many people, and I hope that people understand that these ads and these types of mechanisms are set up so that people can be compensated in some way for their efforts to create these videos. So the other thing that you will see is that I will begin to link on my videos. I will start linking past videos that I have mentioned in my newest videos. I often reference past videos. So I'm going to begin to start using the bubbles that allow you to click on them to reference past ones. And hopefully that's not too bothersome to people, but I welcome any feedback on that, especially that and the ads. Now, the other change that I've made is that I have made my channel videos Creative Commons based. I don't know if you're familiar with that type of copyright, but basically it's a Creative Commons copyright that allows you to incorporate the videos into a video that you have chosen, as long as you give attribution to the original author. So if you want to take my videos and edit them or embed them in another video, you're welcome to do that. And that's the Creative Commons license. So hopefully those changes aren't too extreme and too bothersome to people, but again, I welcome people's feedback. If that is, go ahead and leave a comment and I will react accordingly. So let's jump over to Jim Willie, and his new article is Gold and Fraudulent Traps. Now, I don't really want to cover all this. He covers a lot, especially what's going on in Europe and the problems in the U.S. banks. I want to concentrate on the gold and silver because he's making some calls on those. So let's jump down to the gold and silver. Gold and silver ready to rebound. The gold market is on the verge of a powerful move. The reversal base has been created. The 1620 level was tested successfully a few times. The uptrend has been defended and should continue in a powerful surge upward. The Chinese have been buying with both hands on the physical market, as the London traders report. They took full advantage of the horrendous display of market interference as the gold contract margins were hiked in repeated fashion during the price declines. It was engineered. The nasty ambush appears over. A bullish divergence is clear as the daily stochastics showed positive signals while the price was forming a flat bottom near the 1600 level. A powerful reversal is in progress, one that echoes the reversal in the euro currency from 132 up to 140. Gold had fallen on the back of the euro decline. Now the gold price is rising from lack of resolution witnessed and confirmed in Europe. The gap to fill should be swift, easy, and loud. The gap from 1670 to 1770 is a full 100 points. As it is filled, the naysayers on gold will have to defend why they advise clients to abandon the only true haven safe haven in the financial universe, gold along with its little brother, silver. The growing economic recession will reveal many dead objects in the flotsam and jetsam, much like a tide going out to sea. That is a primary function of recessions, to clear the deck of bad debt and start anew, to plow the soil and permit nutrients to work again. Gold will shine. Gold is not loaded with fraudulent traps and snares built by Wall Street from the devious, risky paper realm. Gold has no fraud from counterparty risk. Gold is legitimate money. The United States will be forced back to the gold standard, but it will be the currency used over a landscape that features rubble, ruin, and discontent. Be sure that every measure will be taken to save the current system, to debase the major currencies in every possible way at the greatest allowable volume. The US dollar and other majors will be wrecked in the process, and gold will be lifted in value in corresponding opposite fashion. The Western leaders have no desire to reform, to yield power, and to install a viable, sound monetary system. Banks should become utilities, not casinos and helms of market control. A grand disruption cometh. Now he gives the gold chart, and he outlines some divergences and a gap that needs to be filled. Here's the gap here, about 1770 to 1670. You can see we're rising into that gap. Very bullish chart. The Europeans provided the trigger on Tuesday for the big $50 move up in the gold price and the $1.50 move up in the silver price. Their bankers, politicians, and commissioners are in deep discord. No solution exists. Big bond losses are coming. Big banks that are already insolvent will topple. The Greek government debt will default. They're trying to make the default orderly. The gang in crisis resolution talks could not be more in discord. The Germans want out of the obligation of being the savings account of last resort to use. The Germans are actually working toward a new alliance with Russia and China and the Persian Gulf. They look east as they see in the West shambles. If the Euro banks benefit from a big bailout from a $2 trillion filled fund at a minimum, then the monetary debasement will be great for gold. Tremendous leverage would be the only means of supplying that volume of funding. The Europeans dislike the Geithner concept of heavy leverage usage. If the Euro banks do not fail to secure funding and cannot recapitalize, a string of bank failures will rock the continent. The contagion will slam London and New York like a tsunami. The crisis would intensify to a new dangerous level that brings talks, finally, of systemic failure from the banking system collapse, which will be great for gold. Those who jumped or were pushed off the gold locomotive in September are the real losers. If they relied upon the leverage inherent to the rigged futures contract game, shame on them. Let them climb aboard on the legitimate rail cars that feature physical gold bullion benches, not paper fake asset. Finally, attention has grown on the gathering storm of Italy. Their debt is being downgraded steadily, just like Spain. The Italian Prime Minister seems like a clown in a suit, calling the crisis a fiction written by the press. They reject austerity measures as their debt runs out of control. The nation of Italy must fund over 200 billion euro debt before the end of 2012 from rollover. Their bond yield has surpassed the 6% level, known to serve as the alarm bell. Then tack on fresh debt. The Greek domino could easily push over the Italian domino, which lies next to the fragile Spanish domino. The European Monetary Union will break. Germany announced the return of the Deutschmark, the date unclear for relaunch. It will be priced for conversion at €1 to 1.95 D-marks, the same as the 1999 exchange rate when the ill-fated euro was born. Regard this vehicle as a transitional currency to a new gold-backed currency, the US dollar killer, the ticket to the third world. Details are in the October Gold and Currency Hat Trick Report. So that's Jim Willie, always excellent. I will link it, encourage you to read that. So once again, we are rallying, not strongly but somewhat, in silver after the somewhat type of panic we had over the weekend about the initial and maintenance margin requirements. So I hope my explanation makes that clear, that they have no intent of crashing the prices of commodities based on these reactions from moving the accounts of MF Global to others. And so we will wait and see how we react tomorrow when the New York futures markets open, where the bulk of the trading will be done. But my guess is silver and gold will probably rally tomorrow, if not anything but just a relief rally from this news that came over the weekend. And we'll talk to you next time.